Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding Podcast, sitting alongside my co-founder, Mr. Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going well. We hope it's going great for everybody else as well. Hey, we are going to be in New York, November 11th through the 15th. Maybe you're listening to this now when we are in New York.
Right.
If so, reach out to invest@focuscompounding.com if you want to meet up with Geoff and myself to talk about our money management services, either through the fund that we are launching January 1st, 2020, or through the managed accounts. We have something for everybody, whether you're a qualified investor or a non-qualified investor, and you're interested in learning more about it, definitely reach out to invest@focuscompounding.com. Also, if you're not following me on Twitter, you definitely should be. That's the best place to get all the content that we put out, and that's at Focus Compound. So in today's video, we are going to be doing our 5 minutes on 5 stocks again. The first 5 minutes on 5 stocks. That was very well received, and I think it's good because it's, I guess it adds a level of, being practical to the investing process. So we're going to do that again. So I ran a screen. I picked 5 random stocks, have quickfs.net up, and, we could just kind of read it off and kind of see what your thoughts are and whether or not you think it would be interesting to do a little bit more research on it. And of course, for the most part, as long as the screen was right, these all should be overlooked stocks.
Yeah.
But we could just go through the process. So the first one that I pulled, this was completely random, is K12 Inc. Okay. Ticker LRN. Have you ever heard of the company?
No, but it's going to have something to do with education.
Learn.
K12 and its ticker's LRN, yeah.
So do you have any thoughts on the education industry, like
for-profit?
Yeah, I mean, I remember Strayer University was a stock a couple years ago. I don't even think they're public anymore. They merged with someone, and I forget. But yeah, do you have any general thoughts on the industry in general? Like, would you just kind of quickly be like, I don't know if I'm interested in it because it is for profit?
Yeah, I don't know. I have looked at analyzed some years ago when there were a few hot stocks in it that kind of became busted growth stocks. I think the one I looked at the most was Apollo, but there were other ones that people liked a lot and they get written up a lot. If I remember, they were mostly heavily shorted kinds of stocks, whereas then there were other people who liked them for their free cash flow and all that.
Yeah, I was going to say it's probably an industry ripe for sketchiness too, if you think about it. For profit, you know what I'm saying? I mean,
it's very, very marketing driven.
Yeah,
but you have to understand
not quality driven or
but you have to understand that like the community college system in the U.S., for instance, which would be one of their big competitors probably, has very low graduation rates. Like I mean, there's some and some state colleges that are catering to first time in their family going to college. I know someone who works at a college that is not for profit. It's run by a state, but it's focused entirely on people who are the first in their families to go to college.
Really?
And I would say their 6-year graduation rate is around 20%.
Interesting.
Yeah, so about 80% of the people will not graduate within 6 years.
Wow.
So that sort of thing is likely to happen in for-profit stuff, and it's likely to happen online and all that.
Sure.
Compared to like 4-year expensive colleges. Yeah.
Got it. So let's go through some of the, I guess, snap judgments, if you will. So the beta is 0.32. So already that could be pretty interesting. It has a market cap of $790 million.
What does this company actually do? Because it's called K12, so I assume it isn't for-profit college or anything like that.
Yeah, let's read their business description. I have Yahoo Finance pulled up. Is a technology-based education company. Together with its subsidiaries, provides online curriculum, software systems, and educational services to facilitate individualized learning for students primarily in kindergarten through K-12 or through 12th grade in the United States and internationally. Interesting.
So maybe
it also offers full-time programs, virtual and blended public schools. So it's pretty much like an online school, it sounds like, for kindergarten through 12th grade.
Has a lot of employees. You just showed me that's 4,550 full-time employees, does it say?
Is that what it says? That is what it says.
It's a huge number of employees, so I don't know what that's all about.
Interesting.
Yeah.
Let's go to let's find out about the share turnover. Okay. I'm kind of curious to look at that.
What's the market cap on this, by the way?
Well, QuickFS says $700 million, but Yahoo Finance says $800 $418 million. Enterprise value $672 million. So it looks like they have
We could figure
net
that out
cash.
ourselves if we knew the shares outstanding and stuff.
Yeah.
You could do that just by looking at the 10Q.
Okay, so we got average 3-month volume 354,850. Can multiply that by 252. You get 89 million shares. And what's the shares outstanding? 40.96. So it looks like it turns over.
It turns over a lot. It's in heavily shorted though.
Yeah.
It's not very heavily shorted.
Interesting. Okay, so let's go back to
So it
the
may
actual.
it may not be a overlooked stock.
No.
We don't know that.
Yeah, but we could just talk through it and
Sure.
just what your general thoughts are. So revenue growth, let's see, a 10-year CAGR on it has been 12.4. So that's pretty interesting. Assets, 13%. EPS has grown by 8% for a 10-year CAGR. We could just quickly look at EV to sales. It's 0.9. So again, just sort of as a rough estimate, Geoff and I usually just look at EV to sales. If it's 0.9, move the decimal place one time, and you should be looking for operating income margin of at least 9%, and that they've hit that in some years. And it looks like they actually did in 2010, but since then it's kind of been declining. The 10-year median margin for EBIT's actually 3.4%. Free cash flow margin, 10-year median is 6.4%. Gross profit, 37.7%.
The one thing I'm seeing that's odd here is the free cash flow margin looks high versus the operating margin. Is that right? Or is
No,
that
it
just a
does. Yeah.
fluke?
No, that. I mean, assuming QuickFS is getting this correctly, that is true. And the EV to free cash flow, it's trading 10 times. So that's kind of interesting.
Okay, so it seems like free cash flow is high, and it also seems like growth is high.
Yeah. But the problem with that growth, is the return on equity is kind of low.
Yeah, but how is that possible unless they've been adding to their share count and stuff over time? So just so people understand, if it shows you a low return on invested capital or something like that, or return on equity for a company on an earnings basis, it would have to be raising capital to grow as fast as it has, unless it has been using its cash. Its cash earnings might be different than its reported earnings.
Yeah.
Because the cash earnings are going to determine what you actually can put back into the business and how fast you can grow. So you wouldn't be able to grow at 12% a year without a higher return on equity, unless a cash return on equity, unless you were issuing shares or something like that.
So let's see. That's so a cool part about QuickFS is they have a section on there called download financials, and it literally looks like a model, I guess you could say, that an analyst would do. So I downloaded the financials really quick. This has going back to 2004. And if we look at the income statement, the diluted shares outstanding has gone from 10, I'm assuming this is in millions, right? 10 million. And to 2019 to 41 million. So you're right on
10
that.
to 41 means it doubled twice in how many years?
That was since 2004.
So 2004. So 2004 to 2019, it doubled twice. It's grown in shares outstanding probably by like 10% a year or something if you do the math on that.
I mean, and even if you go from 2010, diluted shares outstanding were 30 million, and then now currently they're 41 million. So the past,
So if that's true, then it does have a low return on equity, possibly because it hasn't been self-financing. It's actually been issuing shares to accomplish that. Now, we don't know at what price the shares were issued and all that. We'd have to look into that to see how much they really raised from that. If they issued the shares at low prices, then actually they didn't finance much of the growth with it. They do have per share figures for QuickFS too.
Dude, this website is awesome.
Yeah, so you can also look at that.
Where are we going? Where are we looking at?
So just over time. So revenue per share. Do you have revenue?
Oh yeah, here we go. Revenue per share. So
how much has that gone from?
Okay, so in 2004 it was 7.12.
Yeah,
and then
the problem though is look at 2007.
2019 it was 24.
Yeah, but it's not up at all over like 10 years, right?
Yeah.
Yeah. So something's been going on where in the last 10 years or so, the share issuance has been very high versus the revenue growth.
Yeah, I wonder why that is.
Yeah. So
so that's something that if you wanted, you'd be intrigued to learn a little bit more about why.
Yeah, I mean,
that's
unless
been
something
happening.
completely changed with this company, it would be no for me very quickly because I'm not interested in a company that grows its shares that fast. That's just not going to be something.
Yeah,
I'm
maybe by
interested in.
10% per year.
I think that's the number. Yeah, just so people know the way to do that. The way I just did that, you can look at QuickFS at CAGR numbers and things. But one way to do it is obviously to figure out how many years it took for it to double and how many times a number is doubled.
Yeah.
So if you just look at like the 10-year number and you say, okay, it more than doubled or something like that. Well, if it doubled in, using like the rule of 72, if it doubled in 7 years or something, that would be about 10% or something like that. And I thought it looked like it had doubled twice. It had quadrupled in about 15 years or something. So I estimated that it was probably 10% CAGR.
Got it. So you would not be interested in that company?
No.
Right away. Okay. Shoe Carnival Inc. Have you ever?
I know this company.
Do you?
I can't remember.
Ticker SCVL. Market cap $529 million. It's currently trading at a PE of 13.5 times. EV to sales is 0.6, so we would like to see an operating margin maybe in the area of 6%, or at least that it's hit it. 10-year median margins is about 5%. Doesn't look like they've actually ever hit 6, but they did get close to it. So I guess if we want to round up, it's been 5.7. Let's see, 10-year CAGR for revenue has been 4.7%. Assets 3.6%. Free cash flow has a 10-year CAGR of 17% and EPS of 23.9%. So it looks like they have some sort of operating leverage or something
This
in
is
there.
either a wholesaler or a retailer shoes, because the gross margin is average is like 29%. The EBIT margin is like 5%.
Yeah.
I've owned a shoe retailer once, I think, a long time ago. That I got very cheap on sort of a Ben Graham basis. You have to read the business description, because I'm wondering if they do any wholesale stuff or if they're just retail.
Yeah,
or
let's
what.
see.
But from those margins, we can see that.
Beta is 1 point. It's 1, I guess, just
Yeah.
1. Let's see. Shoe Carnival Inc., together with its subsidiaries, operates as a family footwear retailer in the United States. The company offers various dress, casual, and athletic footwear products for men, women, and children, and accessories such as socks, belts, shoe care items, handbags and sports bags, backpacks, scarves, and wallets. As of February 2nd, 2019, operated 397 stores in 35 states. In Puerto Rico, the company also sells its products through online shopping at shoecarnival.com. Shoe Carnival Inc. was founded in 1978 in Indiana.
I don't love shoe retailers generally. So the thing with shoe retailers, I think, is they have a pretty strong position versus their
I gotta look up
suppliers.
an image of this, because I'm pretty sure I've been to a shoe carnival in
Okay.
Illinois. Let's see. I mean, like when I was young, like I just have like a visual picture in my mind of like looking at Skechers there. I've seen this place.
Yeah.
Haven't you seen this place? I've seen this place.
Okay. I've never been to a shoe carnival. No.
I feel like I definitely have, but yeah, I feel like
I'm not a shoe
Retail.
aficionado. I usually own one pair of shoes.
I'm more of I have a one pair of gym shoes for the gym, and then I don't know if none of my other shoes really have laces on. I'm more of like a slip-on guy.
Yeah.
Yeah.
Yeah, so they the margins are okay. The returns on capital don't look that great, which means that probably inventory turns aren't that good, or turns in general. Also, if they're leasing all those places, then those are terrible returns on capital.
Yeah, if you look at the return on equity, let's see, we could get, does it give us a, 10-year median returns, return on assets, 6.2%, return on equity.
It looks like return on capital is like 10%.
Yeah.
I mean, if we're looking, I'm looking at a graph right now, and there were some briefly bad years, but it's wobbled around 10%.
Yeah, look at 08.
It's pretty, yeah, but I'd say it's pretty stable. 10% is definitely the central tendency there, from what I can see. 10% is, if you're leasing stores and things, is a poor return. I mean, because it's really a form of leverage. So if that
what's a good
return
for leasing stores?
it would have to be really high, really, really high. It depends, but I don't know how they're leasing the stores. But it's just dangerous. I mean, even a retailer that's earning 15% or something, that's not that impressive because it's leasing all the locations. I mean, that's a really weak return to ever have numbers that are in the single digits, because you have to understand that if that return on capital isn't taking into account the fact that they're leasing, that means that if they were to own these things, the return on capital would be very, very poor. It's kind of like supermarkets or something. Supermarkets often will own some of their locations and then lease other ones. You have to adjust them. We had a write-up of Kroger on the website, I think, that went into that, where they own about half their locations, and so you have to adjust it for the half.
Looks like they have some debt. Market cap $527 million. Enterprise value $736 million.
Retailers aren't my thing.
Yeah, no, I agree. Agreed.
The shoes are pretty predictable over time. I don't know how differentiated.
Retailers on very thin margins.
Yeah, I mean, for a retailer, those margins are okay. The gross margin is not great, but the operating margin is fine. There's not a lot of expenses to running a shoe store, but you have to rent the place, and then I don't think you're turning over fast enough.
Yeah.
So the returns on capital, if that's true, just don't look good to me.
Okay. Next stock. Let's see. Jeff's favorite place to shop. Ethan Allen, Interiors.
Okay.
They got one right around us.
I do know and I wonder if it's open, because I never see anyone parked out there.
Yeah.
So Ethan Allen is
Furniture. Yeah, furniture.
And not very high-end furniture, more middle of the range.
Yep. Yeah. Okay, so market cap $519 million. It's currently trading at 17 times earnings. EV to sales is 0.8. So let's see. It looks like they've kind of hit that sometimes, an 8% operating margin. 10-year median for margin for EBIT's actually 7.2. 5.6 for free cash flow. Gross profit 54%. 10-year median margin, obviously that's pretty high. Revenue 10-year CAGR 1%. Yikes.
Yeah, so these numbers look terrible to me.
Yeah. And even the return on equity numbers are just awful.
Right. We're basing this off of, so first of all, this is not a kind of company like Nebraska Furniture Mart or something that I might be interested in. This is a company that has pretty big gross margins. So there's probably some amount of design element to it that sometimes is popular or whatever Ethan Allen looks like. I don't know enough about furniture to know.
Do you think,
sometimes it's not.
What do you think the gross margins are on like a Nebraska Furniture Mart, if you had to guess?
At most, I would say that they're 2/3 of that number. I don't know off the top of my head, but I can't believe that they're anywhere near 55%.
Yeah.
So again, if it's leasing locations, then the return on capital is poor. The fact that revenue only grew by that is extremely worrying because this has been 10 years. We're starting this period in 2010, which is a poor year for furniture sales and stuff, and we're ending in 2019. To have barely grown at all over that time, to not have grown at all in real terms.
I mean, we could even go from 2000. 2011, 679. To 2019, 747. But even go back, 2012 was 729 million in revenue, and to 747 million today.
Yeah, it seems like gross margin is fairly stable. And then the problem is the amount of sales that they're doing through it, so the volume of sales. So it just seems like they have insufficient sales volume that they're doing.
What do you think about the retail business for furniture in general? Is that something that's always going to? Yeah, is that something that, for example, I don't know. Do people that's probably something that people enjoy going in the store to actually check out and see, I would imagine, right? As opposed to looking for something to buy on Amazon.
By us, we have a Nebraska Furniture Mart and IKEA, and their business models are much better than anyone else in the area, so they would devastate them. In terms of if it was...
Who would devastate who?
Nebraska Furniture Mart and IKEA, these companies can't compete with that.
Yeah.
So they have business models that make a lot of sense and that are better than that. There's a bunch of Nebraska Furniture Mart stuff in this room. We're looking at some stuff that you can't see that's from IKEA. So I don't think that they can get their prices down anywhere near those things because they can't do the volume in one place. You have wide selection. You have all those advantages. So that there's one dominant furniture retailer in each metro area, I believe, yeah. Mm-hmm. But each time there's a recession or something, another one gets pushed out of business. Everyone wants the one that has the lowest prices and the widest selection. You always want to be able to see everything in one place.
Yeah.
Now, it's true that some build around Nebraska Furniture Mart and stuff to hope that they get people who are also looking there, just like you might have car dealers situated near each other. But yeah, I compare it to something like a car dealer business or something that way. I think that, and then even Ethan Allen, let's say, the problem is that it's in the middle range of things. So what would worry me is think about Restoration Hardware or something, that they're more driven by design and a fashion sort of element to it. Mm-hmm. They have a clear view that way. You either do that or you do what IKEA and Nebraska Furniture Mart do.
Nebraska Furniture Mart, you've been in them, obviously, because you have furniture. That place is fun. Mm-hmm. I didn't realize when I was going there that they were going to sell TVs and speakers and everything you could even think. I was like, where's the grocery store in here?
Nancy's Candy.
Yeah, and of course. Alrighty, next one. Wabash National Corp. I think I'm familiar with this company. WNC. If I remember, they do the trailers for semi-trucks, I think, but maybe not. I think I looked at this company years ago. Market cap of $838 million. PE 13.5, EV to sales 0.6, 10-year median margins for EBIT's actually been 6.4%. It looks like in the last couple of years, it's been above it. 2015 was 9%, 2016 had 11% EBIT margins, and it's been slowly declining. Last year at about 5%. 10-year CAGR on revenue has been 10.5%.
Yeah, you see what I'm going to point out here, what my issue is. Give me what the revenue is today.
2.2 billion.
What was it 10 years ago?
It looks like 338 million.
Yeah, 338 million. So either the company grew a lot, or the bottom of the cycle is 80% or something below the top of the cycle.
I think if I remember this company right, it was very cyclical. Because even look at the return on equity in 2009 was negative 98% or whatever. And
the gross margin is that right? I'm seeing on QuickFS a negative gross margin.
Yeah, you're right.
Which is incredible.
Yeah.
So that's possible to happen to a company if they're having overhead cost absorption at a single plant or something. So like an auto parts manufacturer or something could have that happen to them because they are building all their parts or something at one location. They're used to supplying their customers with like 5 million parts, and then suddenly in the bottom of a recession they need to supply them with 1 million. Suddenly the cost of every part shoots up because your labor force is still the same, your factory is still the same, and you're putting that into the cost and counting that in your gross costs. So it's a little misleading. That's not the marginal cost normally of what it would be. So basically your gross costs shoot up in a recession, which could be what happened here.
Yeah, I don't even think this is an overlooked stock either.
Okay.
I mean, beta of 2. Let's see what their business
But that could be a lot
is.
of volatility, not a lot of correlation.
Designs, manufactures, and distributes transportation and diversified industrial products and provides services primarily in the United States. The company operates through 3 segments: commercial, trailer products, diversified products, and final mile products. So yeah, the commercial trailer product segment provides dry van trailers, platform trailers, refrigerated trailers, dollies, big tire haulers,
no one buys
steel,
in the middle of recession because there's no
business.
and that's the first thing that you defer that.
Yeah.
So
very cyclical company. Like we could see, let's see, 3-month average volume, 425,000 shares. We can multiply that by roughly 252 trading days a year. We get 114 million shares outstanding is 54 million. So they turn over, pretty decent amount, more than
that's not
2
an
times.
overlooked stock at all.
Totally not. But yeah, as for, something that jumped out to you right away was the negative gross margins in 2009 and how much the company has grown.
I don't know how the stock did since then, but if you were ever going to buy the stock, you'd want to buy it in a year like 2009. You want to buy a stock like this when the EV to sales is incredibly low, but there's no profit basically. Now, that was a really bad recession, so maybe they'll never get to a point where they don't make any money again. But I wouldn't buy this on like a low PE. You should buy something like that when it has a high PE or no earnings at all, probably.
Got it.
Not overlooked, though.
Alrighty. Next company and last company, Coffee Holdings Company, ticker GVA. That's kind of catchy.
JVA.
Java. Yeah, JVA ticker. Let's see. PE 78 times. Okay. EV to sales 0.3. 10-year median margins for EBIT's been kind of in the area of 3%. Revenue CAGR for the past 10 years has been 2.4%. In 2009, they did $74 million in revenue. In 2018, they did $91 million. Returns have been not interesting one bit.
No, is this a distributor?
I don't know.
What's going on? Because their gross profit is rarely much above about 13% or something. It's hard to believe that do they wholesale coffee to places? What does this have to do?
Let's see.
So,
manufacturers, roasts, packages, markets, and distributes roasted and blended coffees in the United States.
Okay.
Australia, Canada, England, and China. The company offers wholesale green coffee products, which include unroasted raw beans of approximately 90 varieties that are sold to large, medium, and small roasters, as well as coffee shop operators.
All right. So they're supplying the actual raw beans, which is a commodity, to small companies or large companies to roast them on site, presumably. Yeah. So that's obviously a real commodity thing. And that explains why their gross margins are so low. They would have to have very high turns to have decent returns on equity, and I'm not seeing that here.
Yeah.
I'm also not sure how...
Look at the lack of predictability in EPS growth.
Yeah, well...
It's very, very volatile.
One thing that's very concerning is why is the gross margin moving that much? So if you're doing this sort of distribution and stuff... your gross margin, you would hope, doesn't swing around that much. Say you were distributing cigarettes or something. Your gross margin won't swing at all, or drugs. Those companies that do that have very stable gross margins because they buy a product at a very stable price and sell it at a very stable price, and then it's just a matter of the turns. Here, I'm worried about looking at that gross margin. Does that mean that they're not able to handle certain jumps in their input costs or something? Mm-hmm. Are they sometimes buying beans at higher prices, and then when they go to sell it, they're not able to pass that all along? I don't know what's going on there. So, that's very concerning. This looks like I don't want to say bad things about it if people own the stock and stuff, but it just doesn't look to me like the product economics here based on those numbers are good. Now, maybe some of it is the site that we're using, and maybe there's some messiness in their past results. I don't know.
Yeah, but I don't think so, because if you go over to Guru Focus, it kind of Looks very similar.
Yeah, I definitely, if you have a 13% gross margin average, it needs to be a very, very stable margin. It needs to be something like that. This is really worrying me that they seem to have great instability in their gross margin. To give you an idea, I'm seeing moves in the gross margin that are like 2/3 of the entire gross margin. Even if you had a 50% gross margin, you wouldn't want to see swings in it of like 20% or something, right? You wouldn't want to see it be 30% in one year and 70% in another. But that's what we're seeing here just on a low gross margin. I mean, I see, if I'm right, I see 2 years there or 3 years there where the gross margin is dramatically under 10 percent
for gross margins.
Yeah,
Yikes.
so it's not just that it's a low gross margin, it's incredibly unstable. You would want, if you have a low gross margin, to have a very, very stable gross margin. That's usually low gross margin companies have very stable gross margins, and then you would want high turns. It, I guess, has high enough turns that in good years for the gross margin, it seems to have a decent return on equity. I mean, it has 1 year where it has like a 14% gross margin or something like that, and it's able to get like a 20% return on capital. So it's not impossible. Maybe the businesses have scale or something, but the wobbliness of the gross margin
lack of predictability. Would not be interested. 0 for 5 today. 0 for 5, and that's good. I mean, we're not here to go 5 for 5. I just pick random stocks, and it's good for us to talk about. I gotta make sure I actually delete them off of the Excel because then I won't actually. What
stock? If we had to pick one, would we have done more research on?
Well, if we were short sellers, every single one. No, just kidding. Let's see. I don't even know. Because this, I mean, Wabash was incredibly cyclical.
What's the price?
Who the heck wants to be in ETH and LRN? Shoe Carnival, I mean, retailer of shoes, really? Probably not.
You're still paying a premium to book and stuff there.
Yeah.
I don't know. EV to EBITDA.
K-12, I just hate for-profit education. I should be careful with saying that. I don't hate
for-profit
education, but I don't like it as a stock.
I don't like that they're issuing that many shares. If they issue that many shares, I wouldn't buy the stock. So that's not going to happen.
And that's true, though. Their share count's been growing by 10% a year.
I guess it would have to be Shoe Carnival. I can't see anything else here that seems remotely as safe.
Cigar Butt.
I mean, Shoe Carnival and Ethan Allen, but
we are not endorsing you do research on those companies.
No, and I don't buy retailers really, but I guess those would be the better ones to look at.
What a bummer. Well, we're gonna do these videos a lot more often because it's fun. I think it's good for people to hear just the way that you think and kind of walk through the process, and just how quickly you could disqualify a company, and that's it. I mean, you see the share count go up, and that's something that's very troublesome, or you see the lack of predictability in the gross margins, and that's very interesting to people as well. So we're going to do a lot of these videos.
Yeah, it's just a 5-minute thing. There could be cases with some of these managements change their strategies,
totally
completely miss
and we understand, that some of the best companies or best investments don't screen well, and we get that. But this is just kind of what we're doing for the process. So I want to thank everybody so much for tuning in with me and Geoff here today. We are going to be in New York November 11th through the 15th. Reach out to invest@focuscompounding.com if you'd like to meet up to learn about our money management services. If you're watching this on YouTube, hit that subscribe button, thumbs this video up. If you're listening on the podcast side, a rating and review goes a very long way for us. I want to thank everybody so much for tuning in with us. We'll see you in the next podcast. Take care. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.